Hello, welcome to this video where we're going to take a look at responsibility accounting and performance evaluation, which is chapter 9 in your textbook. So after we finish studying this chapter, you should be able to explain why companies decentralize and use responsibility accounting, describe how the balanced scorecard helps companies evaluate performance. We're going to use responsibility reports to evaluate the different types of centers, and then use return on investment and residual income to evaluate investment centers. Now, decentralization is used by most large companies, and if you studied any kind of business course already, you probably are familiar with it. And what it means is the company breaks itself up into segments or divisions. And what that does is it enables the upper management to delegate management of the divisions to lower level managers. So you might have a manager of the Northeast region. And what that does is the upper management is then free to look at big picture issues like strategy and not worry about the day-to-day operations. Very common. So there are 4 kinds of responsibility centers that result from decentralization, and the idea is that each of these centers is going to be evaluated in a different way. So performance evaluation means we're looking at how well this unit is doing, right, compared to what we expect it to do. So the cost center is a center that only generates costs. So that would be something like, say, the accounting department, right? In the accounting, all they do is generate costs. They don't directly generate any revenue. So that department would be evaluated based on actual versus budgeted costs. Now, a revenue center only generates revenue and doesn't have control over any of the costs. So a revenue center might be something like a department in a department store. So for example, if you're familiar with Target, maybe like the kids clothing department in Target would be a department, and that which would be a revenue center. That center manager is only responsible for revenue because they have no control over the costs of the store. They're only running their department, so they would be evaluated based on their revenue versus budgeted revenue. A profit center would be maybe the entire Target store, and that's a unit that generates revenues and costs, and they're evaluated based on their actual versus their budgeted revenue and their actual versus budgeted costs. And then finally, we have an investment center. An investment center does everything a profit center does, but an investment center, the manager has control over how assets, money is invested in assets. And so we want to know how well the assets are generating revenue and income. And so we look at the same thing as the profit center, but then also ROI, which is return on investment, and residual income. Now, the balanced scorecard is a way of looking at a company in 4 different perspectives. And the idea is that we don't want to focus only on finances because there are a lot of things that drive the finances. So the financial results are generally lagging, what we call lagging indicators. In other words, we don't find out until it's too late, right? We know that we had sales of a certain amount last period, but it's too late, right, by the time we find out. So there are other perspectives that the companies might look at that will help them improve their finances, but as a result of improving other parts of their business. And of course, also improve a lot of other things like employee satisfaction, customer satisfaction. So the customer perspective says, how do our customers see us? And each of these perspectives are going to be measured in terms of what we call key performance indicators. So you might see KPIs, key performance indicators. So the customer perspective, maybe a KPI would be market share. And the internal business perspective maybe a KPI would be the number of new products developed. And the learning and growth perspective might be evaluated based on employee training programs. So the idea is, of course, all of these are interrelated. So think about training your employees, and then, of course, your employees are happier and they probably do a better job. And then also your customers might be happier as a result of training. Your business might be more efficient, and then eventually that all affects the finances of the company. Now, responsibility reports are prepared for these centers that we were talking about. And this might look familiar to you. It looks very much like the responsibility report on the bottom here. It looks very much like the performance reports that we prepared in the prior chapter. So what you'll notice is there are some things up here that are not on this manager's responsibility report. Now, this is the payroll processing department, and hopefully you think to yourself, okay, well, that's a cost center, right? Because payroll processing does not generate any revenue, only costs. And so the difference between these two is the responsibility report only shows the costs that this manager is responsible for and has control over. So for example, they took out equipment depreciation because maybe the manager has no control over how much depreciation there is. Someone else made that decision. So this manager is going to be evaluated on that responsibility report. Now, investment centers are evaluated, as I mentioned before, using two different things. One is return on investment, or ROI. And return on investment is calculated by taking your operating income and dividing it by your average total assets. And the average total assets, we usually keep it simple. We take the beginning total assets plus the ending, add them up, divide by 2, and that gives us our average. And so ROI in its simplest form is operating income divided by average total assets. Now, we could take that and break it up into profit margin and asset turnover and multiply those two together. You're going to get the same number. But what this does is it enables managers to look at what it is that is driving the ROI. So they might say, okay, well, the reason our ROI went down is that our profit margin went down or our asset turnover went down. So this helps the managers to look at the different components of ROI. Finally, we have residual income, which is another way of evaluating investment centers. Now, remember, residual is like extra, right? So residual income is how much income did the company make over what it wanted to make, all right? How much income did it make over what it wanted to make? So the income that it made is called operating income. What it wanted to make, we call the minimum acceptable operating income. So how much did it make over what it wanted to make? And what it wanted to make was its target rate of return. So that's going to be a percentage times average total assets. So that's going to be, so you're going to say something like, okay, the company wants to earn 18% on its assets. So you take the 18%, multiply by the assets, and that's how much it wants to earn. And then subtract that from what it really did earn, and that's going to give you your residual income. Okay, so that's all I have for this. I hope that's helpful, and I will see you in the next video.